Hello, and welcome to the A16Z YouTube channel. I'm Angela Strange. I'm a general partner here at Andreessen Horowitz, focused on financial services, and I'm here today with Sankaet Pathak, who is the CEO of Synapse. And we're going to talk broadly about some of the new trends going on in financial services, and in particular why we're seeing so many new consumer and SMB-focused fintechs, and how are those fintechs actually getting to market? Like, what is the infrastructure behind them, and how does this happen? Which is probably an area many people haven't thought about, but is particularly fascinating once you start to dig in.
Yeah.
So thank you for joining us.
Thanks for having me.
Yeah, and so I thought we could start with the founding story of Synapse and how you ended up starting a company in the banking infrastructure space.
Sure. Yeah, so it kind of started when I came to America. So.
And where did you come from?
I came from India. So,
where in India?
India, Rajasthan,
yeah.
Which is like, if people probably know Jaipur, so it's the state of Jaipur.
Yeah.
So I moved from India all the way to Memphis, which is where I came to do my undergrad. I tried to open a bank account, and back then I tried with Chase online. They denied me an account. They said I didn't have a social security number. Did the same thing with Bank of America. They denied an account too. Then I went to my international student orientation program, and they said they had a partnership with Bank of America, so I could actually go to the bank branch and open an account. So I walked to the bank branch because back then I think Uber and Lyft didn't exist, and Memphis didn't have good public transit, so and I was too shy to ask like my new friends to give me a ride.
Can you please drive me to the bank so I
can
get an account?
Yes. Exactly. That was probably awkward. So I went in there and I tried to open a bank account. They asked me for my passport, bunch of these documents. And then it turned out they wanted my advisor to also write a letter saying that I actually am a student at the University of Memphis. So to go back to the university, come back, and I just remember that experience being like extremely strange. But then I thought maybe it's fine. Like when you're coming to a new country, you kind of just takes like none of this infrastructure is really built for you. It's built for people that live there, so it's completely fine. Zip, couple of years later, I've been doing. I was almost done with my undergrad. I was doing a lot of solar physics research back then. That's actually relevant. I'll tell you how. And I'm about to graduate, and I'm starting to think about what are some interesting things I could work on. And this new online bank comes about called Simple. So I try to sign up for Simple. Yeah. And I run into the same problem again. This time I have my social security, but they say they do not accept social security. That's workers only. Like immigrants get a different social security bracket than like people who are residents. So
Simple was proving not as simple as maybe.
Yeah, Simple was definitely
what
not
was
simple.
Simple's value proposition for people who aren't familiar with it?
Yeah, so Simple's value proposition was it was a branchless bank. You could just go online, open up a bank account, and it would let you open up a checking and a savings bank account, which to a college student were like high-class financial products. And some of the pieces that were still frustrating to me about banking were anytime I had to do anything other than swipe a debit card, I had to literally go to the bank branch. To open up a savings account, I had to go to the bank branch. I remember my dad sending me like a little bit of money during my birthday, and they froze my Swift wire until I would show up to the bank branch and talk about the purpose of the funds, and then they released the money. One time I was in Boston and my card was frozen because of some fraud alert, and I had to literally go to the bank for those things as well to kind of demonstrate that I was still in the country, things like that. So I just remember that, I remember that whole thing being extremely frustrating. So I thought, well, if I'm gonna sign up with a bank that doesn't have a bank branch, then they won't call me in. Like they cannot.
They don't have a branch.
Exactly.
I can't go there.
Yeah.
Yes.
So I was like, I cannot really go in there. This is great. So they'd be forced to serve me online, which again, like every single thing they were asking me, they either could have done over a phone, over a video call, over an email. So I really wasn't understanding what was really the barrier here. So I signed up for the Simple app, and they said they don't really accept immigrants. Later I talked to Shamir, who was the founder of Simple, and he said even he didn't have a Simple bank account. But back then I just remember thinking, I guess like maybe immigrant is just such an interesting use case that no one's really optimizing for that. And that was the time when I was really thinking what like one of the most interesting things I can work on. And then back in my head I just remember thinking, why not try to build the Google for banking? The idea being we want, let's democratize financial access for people so that it doesn't matter if you're an immigrant, if you're rich or poor, what have you, you get access to tools very easily online. And because I knew nothing about banking except my experience, I thought what I really need to do is build the next simple. So it kind of started the company with a consumer-facing brand. So we had a mobile app. It kind of worked like Venmo. In version 1, my goal was kind of demonstrate to the partner banks that we can do ledgering, we can do identity verification, we can essentially like underwrite people before we can do anything else. And then I'll slowly persuade them to start issuing debit cards and savings accounts and credit cards. As soon as I wanted to go there, I was like, okay, well, here's how identity verification works with Synapse. You've seen it work. Back then, even concepts like fingerprinting and IP
Wait, so you're backing up. So you had this consumer-facing brand.
Yeah, we had this consumer-facing brand.
But then, okay, so then how did you decide to move from running this consumer-facing brand to try to solve some of the other problems?
Well, so yeah, so what happened was, my thought was I'm going to take this consumer-facing brand all the way and can start adding the same features that like Simple had, but this time it would actually work for everyone.
Right.
So then I go to our partner bank back then, and I say, okay, you see identity verification working the way it's working. You see how we can onboard users. Now I want to be able to issue cards. And they were like, well, you cannot really do that, and gave me like whole gambit of reasons, and most of them were fair. We don't know how to mitigate for this risk. We don't know how to do transaction monitoring really well. We don't really know how to hook you up into our card issuance stack to begin with. Like those things are not modular and just ready for you to just plug into. You're going to have to build all of this out, which is going to require PCI compliance, which is going to require building out a compliance team and all of these things. And I'm sitting there thinking, I'm like, maybe Simple was actually not like, it's not Simple that was the issue. It was maybe their underlying bank. And then I started looking at who their underlying bank was, and then I realized that's exactly what it is. Simple has a bunch of obligations that they've had to kind of outsource in a way to Bancorp Bank, which was their partner bank. And based on whatever their KYC standards were and KYC policies were, that's all Simple could do. So in a way, Simple was just a reseller of an existing banking service that Bancorp had. And then in my mind, I was like, okay, well, how about this? Let's not try to make a new Simple. Let's just try to make a new Bancorp, with the idea being if we can make the underlying infrastructure extremely more modular than it is today, it can accommodate for immigrants, it can accommodate for people who don't have credit history, all these things. Then essentially you've built a much more inclusive stack, and then any developer can hopefully plug into it and build from there.
Awesome. Yeah, so we're going to get into sort of all of the different pieces that are required. But I think it would be good for, folks, some people might say, well, I've got my bank now. I go down to, pick one of the large banking brands. They give me all the products that I need. Like, yeah, maybe I had to visit a branch, but not that big a deal.
Yeah.
So aside from solving the access problem, like why is it important that it's easier to spin up new financial services?
Yeah, that's actually a great question. So we kind of do a little bit of behavioral research internally in the team. So we've kind of classified people in about 3 buckets. So one is someone who needs help financially, like in financial services, they're not very well educated. Someone who needs nudge, which means they have basic underlying education of how financial products work. They just need better process automation to be able to help them budget better. And third group is self-sufficient people who consider themselves as, I have the best credit card on the planet, I have the best savings rate on the planet.
And do those buckets align by income levels or not necessarily?
What we found is not always. What we found is some people could have a very high amount of disposable income, but as it comes in, it goes out as well. And those people end up being in the needs help category because financial education is very low, even though their income is extremely high. One of the most common examples of this would be, think of people who win lotteries. If you would win $1 million or $10 million lottery today, most of those people end up going bankrupt in like 5-6 years. There's a high correlation and likelihood that that would happen.
Yep.
And that goes to basic financial
Whereas
like
if they had
knowledge.
a financial services product that better helped them with that,
Yeah.
that would be a good case. Yep.
Yeah. So now, even if you don't care about access, I think the bigger question that's worth asking is, how can you make sure that finances just work for people and doesn't require you to piecemeal things together?
Yep.
That cannot happen until the basic underlying technology kind of upgrades itself.
Yep.
It's like expecting iPhone to exist if we kind of like did not invent, I don't know, chips, like smaller chips or something like that. People still using like landlines. So you can't really make that leap, and that's the leap you really need to make, which is in everyone's interest. It's in the interest of people who do not have access. It's in the interest of people who have access but kind of don't know how to use these products extremely well. And it's the interest of people who have access to the best-in-class products and are educated enough to be able to use them as well. Even those people usually surround themselves with accountants, financial advisors, portfolio managers. What if you didn't need all of that?
Yep.
What if these things just worked for you?
Well, and you even made the point that more competition would breed higher rates, even for like people who are well served, right?
Totally.
Yeah.
Another big point is like if you're an athlete and you think you're today getting a higher health insurance, or if you're a really good driver and you think you're getting a very high insurance rate from Geico, maybe brands should exist that would service just a customer base like you that are inherently better at underwriting what you do, and that overall even helps people who are extremely privileged too.
Yep.
Yeah.
Great. So I think before we break down, how we can make infrastructure better, I think it would be pretty interesting to talk through. There's been Lending Club was one of the early financial services companies that got going, and now we've got all sorts of like neobanks, as they call them. And so these new companies got off the ground. Many of them took 18 months, 2 years to get launched because there's a whole series of partnerships that need to happen on the back end, usually added technology that needs to be written on top of those partnerships. So I thought we could almost walk through step by step some of those things.
Yeah, that's actually a great idea.
And starting with, we could even start, okay, so you want to launch a new lending company.
Yeah.
You need a license.
Yeah.
You can either go state by state to the state regulators, or talk through the options between that and getting, the sponsor bank and what that is.
Yeah, let's talk about two pieces that we would consider least democratized. People at this point have kind of taken just payment processing for granted. It can happen at scale, and it can happen in a very distributed way. But what cannot happen, and what a lot of neobanks or lending companies are trying to do, is kind of really build out more innovative products on deposit taking or loans.
Yep.
And here's what ends up happening on both of those cases. The first thing you have to do is go and find a banking partner.
Yep. And why? Why do you need a banking partner?
Because it turns out if you actually have to move or take custody of money, you have to be a financial institution in the US.
Yep.
Same with lending. So either you are a bank or you're a lender.
Yep. And who's the regulatory body for that? For a bank, if
great.
you were I want to be a bank, who regulates that?
Well, Fed and the OCC.
Yep.
So more so, and in some cases state regulators as well. But mostly you're looking at a federally chartered bank, so you're looking at the Fed or the OCC being your primary regulator, who would kind of do audits on you every quarter. Most of them are safety and soundness based, which means are you taking more risk than you can afford, which came after the last recession, all the way to are you following the Patriot Act, the Bank Secrecy Act, are your policies written that you wrote is exactly what you're doing on a day-to-day basis, or have you written policies that are completely off?
Yeah.
And then the final piece is the model validation, which is the policies that you've written, are those sound as well?
Yeah.
So they kind of do all of these checks with the idea being that you want to make sure that the underlying fabric of the American economy is fairly strong and pro-customer.
Yep.
So,
and then customers get insurance that their deposits, like FDIC
Totally.
insurance, that their deposits will be there.
Yeah, so FDIC, just like any insurance agency, they would have to do some kind of an underwriting mechanism.
Yep.
And here, their underwriting mechanism is on the financial institution.
Yep.
The Fed and the OCC, again, the same thing. Either they're giving you access to the payment trails, or they're kind of responsible for overall oversight of the currency in itself. And in those cases, they have to just make sure that you're dealing with money correctly. Yep. And then we also have CFPB and some of these bodies showing up that kind of sit outside of the quarterly oversight, but they still have overall oversight on top of financial instruments or products to make sure they're actually not predatory to the end user. So all these regulatory bodies can exist, and as a new company, what you really have to demonstrate fundamentally, without all the pieces, is can you ensure or can you give confidence to the bank you're about to work with that you can comply with all of this?
Yep.
Or can you help them comply with all of this for whatever program you're about to onboard? And that is a daunting task. Like, that piece is extremely difficult. That requires making sure you build and design your programs correctly, that work in every single state accurately, how they're supposed to based on the laws. Make sure, as kind of the consumer standards change, you evolve those programs over time. Make sure you're doing the right identity verification pieces you need to do. Make sure if there's suspicious activity, you have the right mechanisms to detect and report. Like, all these things kind of like go into this. And when you're going and starting to build out any financial product, these are like the underlying things you have to kind of get right.
Yep.
Otherwise, you just cannot launch.
Yep. So like a new company right now for the state, they can't go and get a new license.
Yeah, so this is very interesting. No, because after the last financial recession, there has been, I think, about only 2 or 3 new banks that have actually been de novoed. Almost everyone gets denied because, again, new banks pose a higher risk according to the regulators. So that's,
and there's a few like applications in process now. I think that approval is going to be one of the most interesting things. But for now, the main option is to go to a bank, knock on their door, and sort of prove all of these things that they're going to be able to do okay.
And based on the current regulations, if they stay the way they are, it puts, even if someone were to become a new bank today, for next 2 years, they would be pretty much kind of in a restricted category with the Fed and also with the FDIC. So an example of this is every time you're going to have to send out a Fed wire, you're going to have to give them a call. There are certain limits in place. There are certain processes in place. So they kind of have like baby wheels on you for like first 2 years. And then you also have to raise your capital requirements according to whatever deposits you want to take. The idea being, if your projections are in next 2 years, you're going to have about $100 million in deposits. You need 10% of that sitting in the collateral.
Much more, especially for a new company with a creative new idea, to come to a venture capital firm and say, hey, we're gonna launch this. We have great theories on how it's going to work. Give us $100 million. It's a like huge credit to some of the new banks that have gotten started in the UK that have been able to do this. But that takes a lot of time, and so much easier and faster to go the sponsor bank route. But I think, as you pointed out, it's not like there's a directory of sponsor banks out there and the people to call and how to convince them about what types of companies that they want to work with. And so this takes a lot of time. This
takes a lot of time, and just getting to the sponsor banks is not the only challenge you have ahead of us. It's also demonstrating that you have all of these pieces. By all these pieces, I'm talking about compliance, integrations with payment processing in case of cards, printers,
let's start on the compliance side for a sec, which is, so banks, like multitude of reasons why sponsor banks now want to work with fintechs. Maybe let's start with the benefits. Like, why are banks wanting to work with fintechs right now? And then we can talk about the risks.
Yeah, I think one of the most intriguing parts about this fintech banking partnership is that this pretty much eliminates the cost that a bank has for deposit acquiring, because they don't have to go and advertise to the customer. And they don't also have to build out the front-facing applications themselves. Banks, in most cases, are not good at like building out new software interfaces and tools. And for that reason, even if they blew up their marketing, it would be highly unlikely that they'd be able to get in a lot of these customers. While companies that have been optimized to build and operate on the internet are extremely good at kind of onboarding people.
So they're almost like outsourcing their customer acquisition to best-in-class teams that do this.
So that's like a great partnership, because you're getting deposits at a much lower cost than you would otherwise.
But not devoid of risk, which was the point that you were bringing up, right? So let's assume you onboard a malicious partner that decides, I don't know, they're going to like purposefully launder money from
Oh, yeah.
XYZ country? Like where
Yeah.
does that risk lie?
Well, let's even start at something like most common, which is just like UDAP, which is just
What's UDAP?
deceptive marketing.
Yeah.
So, and sometimes that's even accidental because like the most common mentality in fintechs is fake it until you can make it,
Yeah.
and then you can.
Hey, that's any industry.
Yeah,
It's just
yeah.
that fake it until you can make
Yeah.
it in financial services will land you in jail
It-
versus
it-
some of the others.
It
So you
100%,
can't really fake it.
yeah,
Yes.
it 100% lands you in jail. So that's like one of the most common things that you're like, okay, how can you ensure that you're not going to like deceptively market a product?
Yep.
That's such a low-hanging fruit, and a lot of people get that wrong. Like
Yep.
even
Like what's an innocent mistake that might happen there?
Robinhood is an innocent mistake.
What? So tell us about that.
So here's what Robinhood did. Robinhood launched or at least they debuted a 3 to 4% interest rate checking product
Yep.
without really explaining what built that interest rate, without really explaining how FDIC coverage would work and things like that.
Yep.
So they didn't really have the right
Well,
disclosures
it wasn't
there.
FDIC covered in
Exactly.
this case. Yeah.
Yeah. So there were a lot of questions and very few answers around this kind of launch that they did. And they had to kind of like roll that back, and now they're going to go and launch it again. So that's like a very honest mistake.
Yep.
Other types of honest mistakes could be, it turns out, things that we see commonly. It turns out the bank actually is giving an interest rate on the savings account, which is about 1.85%, and you want to tack on about 2% on top of that. How you have to make sure you communicate to the user that the other 2% is coming from you, not really from the bank,
Yep.
things like that.
Yep.
And those things people kind of get wrong because they're like, well, I don't want to confuse my customer and give them this breakdown, but you have to.
And so if the fintech gets it wrong,
Yeah.
from a regulatory perspective, who's at fault? Does the bank bear that risk? Does the fintech bear that risk? Both?
The bank bears the risk for the primary regulators.
Yep.
Now, we've seen precedent being set where CFPB goes directly to fintech companies and also fines them. But mostly what happens is your primary regulator is going to knock on your door, you're being the bank's primary regulator, and say, do you have no oversight on this? Do you actually not know how to manage these programs? Because if you don't, you should exit this business,
Yep.
which goes down to their safety and soundness.
Right.
Like, do you have the right talent in your bank to be able to build out this wholesale banking business that you're trying to build out? So that's one of the biggest risks any bank faces.
Yep.
Because usually, if it's just one customer, there's some tolerance for this. If there's a pattern of this happening, then that gets extremely dangerous, because then it goes down to, okay, well, if it's happening about 15 to 20 times every year with you, then it might go down to your processes, and maybe you should exit this business.
Yep.
So that's kind of like one of the biggest risks that any bank faces.
Yep. Okay, perfect. So I'm gonna be launching my fintech company.
Yeah.
I've found a sponsor bank and convinced them that I'm going to
Yeah.
comply with all of these processes.
Yeah.
Am I done?
No, actually, you're just getting started. So here's, it's good that you've convinced a bank that you're going to be able to do all of these things. In most cases, and this is outside of Synapse's universe, so we're talking about how this actually works with like Bancorp
Yep.
or somebody else. They're going to give you a list of approved vendors
Yep.
that they have for different functions. Functions being KYC, functions being
KYC, know your customer, identity checks. Yep.
identity verification. Transaction monitoring, making sure there is no illicit activity, terrorist financing, anti-money laundering obligations over there, ledgering, making sure balances are not wrong in your system,
Yep.
payment processing,
Yep.
ACH.
So let's talk payment processing.
Yeah.
So actually explain what is a payment processor?
A payment processor is someone who is connected to any network, may it be ACH, which is bank-to-bank transfer, or Visa and MasterCard, which is interchange. And on behalf of an originator, which in most cases is a bank,
Yep.
they can originate an instruction for a transaction and move money. In some cases, they can pull money. In some cases, they can push money.
Yep.
If you're doing a neobank, then you need a processor to be able to issue and process cards.
Yep.
So when your customer is going to swipe a card at a restaurant, the message goes to, let's say it's a Visa card, it goes to From the swipe, it goes to the bank that's going to acquire that transaction, then it goes to Visa, then it comes to your processor, who then decides based on the balance of the account, the status of the account, a bunch of other things, if the transaction should settle or not. And based on that, gives that instruction back in real time. So you kind of need that piece. Even for account funding, being able to help move money into the system, you need bank-to-bank transfers, or you need to be able to parse through these like processing files as payment instructions come in. So,
or if I want to deposit checks into my new account,
all
like
of
that's
these
somebody
things.
totally separate. What if I want to use ATMs?
Someone totally separate. So ATM separate, ACH is separate, card processing is separate. In most cases, even card processing has two pieces, acquiring and issuance. Issuance is you issuing your card. Acquiring is what Stripe does, so being able to kind of like process a third-party card. So if someone brings a Bank of America card to you and you want to process that, it turns out in most cases those two processes are separate too. So yeah, like, and then you want to do Fed wires, that's mostly a separate processor. If you want to do like cross-border money movement, that's a separate processor. So yeah, a bunch of different ways to move money, and mostly people specialize in like one of those fields. So
and this requires right now, so it's luckily that a lot of these services exist, and as evidenced by some of the companies in the market that, you know, admittedly have taken 18, 20, or 24 months to get going. You know, they've gone, this is maybe 8 different partnerships that you've described, and they can launch, and they can...
well, 8 to 10, because the pieces we haven't talked about is other use cases. We can talk about how this applies for lending, but in case of neobanks, your customer wanting to pay a bill, and the way they pay a bill is with a check. Do you send them a checkbook, or do you on-demand print a check and mail it? Different vendors on both. You have to print and mail your card, a different vendor there. So like, yeah, like there are like so many
Getting the card art right is a problem that I hadn't thought that much about, except for it is probably the #1 pain point of card design from most of the new companies that I talk to. So
we actually did not, and we can talk about that probably more, but we didn't anticipate how difficult just the card printing piece is. That's extremely fascinating.
But I think it just underscores one, the importance of companies in this category wanting to offer great user and design experiences right down to the card, and just that is difficult to line up with all this infrastructure. And so then how, from Synapse's point of view, you look at this infrastructure, how did you start? Like first you needed banking partnerships.
Yes, so we needed banking partnerships, and we had to essentially kind of build all of these things.
And they'd be attracted because they're like, well, I'm a bank, I see the opportunity to get these free deposits, for instance, from a whole bunch of different startups. But then they're like, well, I then need to decide what startups do I want to work with. How do I manage to make sure that they're complying with all of the sort of KYC, AML regulations, et cetera, et cetera? So,
so from a bank's perspective, what they're really looking at is, let's say I've found 50 companies that I think are gold mines. They're going to bring me so much deposits. Okay, now how do I go and make sure I have the right oversight on all of them? How do I make sure they, in pretty much a symmetrical way, have their policies and procedures built out? This is just extremely tedious, and what you're really expecting is that you're going to be able to get the same outcome 50 times. So what something like Synapse is doing is saying, you know what, we're going to centralize all of this, with the idea being everyone kind of follows the same set of rules in a way, same set of processing rails, all these things kind of like are very symmetrical. With that, oversight becomes a little easier than it would be, and then mostly your focus on oversight ends up being like the UDAP stuff. So are you marketing the product correctly? Is it friendly to the end customer? And those pieces are at least easier to measure and monitor because you can do them on a quarterly basis or something like that, versus also having to make sure that the daily oversight functions are being done correctly 50 different ways.
And how are you, like I was just reading, the compliance staff increase at banks, which has been a big topic since 2008. I think the latest stats for someone like Citi, they have 30,000 people in compliance, like 15% of the workforce, which as a startup, you just wouldn't be able to hire that many people. So are there any areas like that you've been able to like use technology to do things better in like KYC, AML, or like ways that you think you'll be able to reduce staff in that area in the future?
Totally. So I think it's good to understand why banks hire compliance people. Banks have started hiring compliance people since 8 years ago. That's because more additional obligations were put on them, a lot around transaction monitoring, identity verification, things like that. And if you would just look before 8 years ago, banks were not technology companies. Banks are still not technology companies, so they've had this additional layer of oversight that's been put on them. And the only way they know how to respond to this is how they have responded to problems before, by adding more people. We're primarily a technology company, so a lot of the pieces that you would have to hire humans for, you can try to automate them. Something as simple as identity verification, reading a government ID. You can kind of use computer vision or CR to be able to start really like fine-tuning that tool. When you talk about just transaction monitoring, you can use like LSTM type models to be able to, that plus time series, you can kind of like build out some models there. So a lot of the back office functions that banks are hiring people for, you can by and large automate depending on what type of operation it is, from like 80 to high 90s%, with the idea being what we care about is hiring like extremely smart compliance people that can find deficiencies and can keep good oversight. And if we can do those things well, then though the system, I would never consider the system automated. I would more so consider the system autopiloted. It's mostly autopiloted with kind of like your hand on the wheel, like almost all the time, with the idea being we're gonna, if something goes wrong, we're there to take over. And Synapse is not the exception to this. Other fintech companies are pretty much doing the same thing. It probably becomes a focal point for us because we live or die by this, because our entire business is wholesale banking. Our entire business is building this infrastructure. So we kind of have to really get this one right. And if we have to hire, I don't know, 5 compliance people per new 2 platforms that we add, some kind of a scaling function like this, then that really starts like reducing overall the business merit of this.
And so then, so you've got your banking partners, your program management.
Yeah.
What are the other services that you offer? And how did you think about, like, what do you build yourself versus what do you partner with?
Yeah, I think here's the problem we're trying to solve in a recursive way. We want to reduce the barrier to entry for anyone to build and deploy financial products. So we're always going to kind of like just keep on building things around there. The most common one that we talked about is banking partnership. The second one is compliance and back office automation. The third one is all the processing layers. So most of the work that you see in Synapse kind of happens on those 3 verticals, right? So
and the processing, like supporting swiping of debit cards and
ACH processing, RDC, remote deposit capture, check issuance. The goal being, if one of the end customer has a deposit account that is hosted by Synapse's infrastructure, it cannot seem like a step down from what you would get at Wells Fargo. It almost has to be either the same or better. So you have to have all those functions. You have to have the check piece, you have to have the bank transfer piece, you have to have the card swipe piece, all those things need to exist. So those 3 pieces we kind of like constantly keep on going back and forth on. Then there are other pieces as well, like kind of reducing support costs for customers, so really getting customer support, being able to deliver customer support at scale, then being able to also help people find customers, so reducing their CAC over time, and then finally like capital. So I think those pieces we'll kind of work on as well. But how we think of this is like the problem that's ahead of us is reducing barrier to entry to build and launch financial products. So we'll kind of build products in any of those categories that we can. We tend to partner on things that we think we cannot do ourselves in the short term. So banking partnership is extremely fundamental. We're most likely not going to go and get a charter. Our goal today is how can we make this infrastructure more global? So finding regional partners is like key for us. Then other things like when we got up and running with a card issuance stack, initially we partnered with Jack Henry instead of building that ourselves. and then took about like 8 months or so to start building that ourselves. So sometimes, depending on kind of like what products we want to launch now versus later, we might partner on some of those products as well. But in most of those cases, what we found is building some of those things in-house just gives us the flexibility we need to be able to kind of move these parts around like correctly the way we need to be able to build whatever financial instrument we need to.
Yep.
So we partner less compared to most companies. We build most of it.
Yep. And so I want to rewind a little bit before you were, as known in the industry.
Yeah.
You're a new startup. You're doing something critical like banking infrastructure.
Yeah.
How did you convince your first customers to use, no-name Synapse versus, other companies or other banks that they might have known before? Like they know it would be slow over here, but at least a little bit more established.
Yeah.
Like, how did you get over that hump?
Yeah, I think our problem is just like any infrastructure company. Initially, you're going to have folks that are a little more tolerant of risk. So they're going to be like, it's super critical for me to be able to build and launch some of these things, so I will do that. Plus, they kind of like relationally start knowing you. So they're like, okay, we're going to bet on this team.
And your pitch to them was speed, or what was the early pitch to the fintechs?
Well, so one of our very early pitches were speed and access.
Yep.
It was extremely hard when we got started. In most cases, it still is for most companies to be able to get access to these products. So we were like, hey, we're going to give you access, and we're going to give you access very quickly.
Yep. Meaning, if you're like not a brand name and you go knocking on a bank's door, like they're not going to pay any attention to you.
Totally.
Yeah.
And then the second piece
rightly
is
so, because they don't know how to, like, it's not their core competency to evaluate, right?
Totally.
So, yeah.
And on top of that, support. Like we had Slack support. So you're like, I'm going to give you Slack support. My core team's going to give you Slack support. So usually that ends up working out for like startups when they can give like good support to their customers and also can kind of like get them to market faster. Those were the things we thought were most valuable to our customers. Over time, that still has remained to be true. But what we found also is because we built a bunch of these things in-house, adding more incremental products is easier for us. So in most cases, it ends up being easier for us to add those products for them than them having to go and get those somewhere else. So those have helped over time too.
And are your customers, they're just signing an agreement with you? Are they signing an agreement with you and some other partners? What does that look like?
Yeah, so since we thought the best way to be able to solve this problem is be a one-stop shop. So we've kind of like always only partnered with people where no tri-party agreements are needed. So they just come and sign an agreement with us, and then we kind of manage everything else behind the scenes.
Yep.
You have to still get a lot of approvals, right? You have to get the approvals from partner banks. You have to get Visa to approve if it's a debit card, their co-brand. If the lending company and then push money to a debit card, then getting their program approved. So you have to do a bunch of these things behind the scenes. But here's the fun part. Once you do them 50 times, you're so much more optimized to do this versus this company directly themselves.
Yep.
Now, if this company had to go and partner with MasterCard to use MC Send, the product, they just wouldn't even know how to prepare for all the obligations they have. And one of the most common things MC Send, a MasterCard push to debit product asks is, what's your anti-money laundering program? Guess what it is? The same across 100 companies or 200 companies. So now they've understood that program so much better. So overall, what you're seeing is kind of centralizing this has benefits to everyone because the process starts becoming a lot faster than it used to be before.
Makes sense.
Yeah.
So sitting in your seat, you get to see like the first instances of probably a lot of interesting creative ideas. What are like one or two examples of companies that you have worked with or will work with and that they're doing?
I think one idea that admittedly me and also other peers of mine and friends of mine, mostly in venture, kind of like underrated was Dave. And I think a big reason for that is most of the people that now I'm probably like hanging out with or in close proximity with are people who are well off financially. So when a product like Dave comes about.
And what's Dave's product?
Here's what Dave does. Dave says we're going to ensure that we're going to try our very best ensure that you're never charged an overdraft fee again.
Yep.
Well, how do you do that? Well, you sit and monitor people's account on a regular basis, and if it turns out there's a likelihood that they're going to overdraw because some charge is going to come in that's recurring or something like that, you just push money into their account just to cover that so that the account doesn't overdraw so they don't have to pay overdraft fees. Most people thought there wasn't a lot of demand for a product like that, and we have been blown away by like how many people actually use a product like that.
Well, and overdraft fees have gone up like to $35 now from 20 just 10 years ago. As I was checking. So that's a pretty big chunk of change.
Yeah. So that product we've been like, I think a lot of people were caught by surprise. Some of the other products like. I've been like a huge fan of like Empower. Empower is one of our new customers. They issue debit cards and give you a savings account as well.
And a higher yield savings account.
A much higher yield savings account. I believe like 2.15%, something like that. And over there, at this point, I don't have an account with Bank of America, Chase, Wells Fargo, anyone. I literally only have my customers' cards in my pocket. So like they've built a very good interface for this. Overall, the experience of the product's solid. My transactions get categorized correctly. As soon as I swipe my card, I get my notifications. So pretty much at this point, in a couple of months, they've been able to get at par with any other neobanking customer you can think of. May it be Chime, may it be Varo, all of these people. They started after them and now are at the point where we are, and next couple of months they're going to be ahead of where they are. And they've kind of like executed on this fairly quickly. So those people have been extremely exciting. Do you have some like new partnerships that I think would be extremely intriguing too, but I should probably not.
All right, well, we'll save that for a follow-up conversation. I want to chat briefly about sort of company philosophy, and one of the things you've done is you publish your roadmap. Why did you decide to do that?
It was actually extremely pragmatic. We were hoping to be able to ask our customers what they were going to work on, and in some cases, they were secretive about it. In other cases, we just started having a lot of customers, so it just didn't seem like we could have that conversation with everyone. So what we decided was, instead of trying to like pull this information out of them, why not we just tell them, okay, this is what we're going to commit to building this year, with the idea being if they have that in their vicinity, they would know that, hey, we're here to kind of help you with this in next 12 months. And that was the reason we just started putting it out. It also motivates the team a whole lot because like, okay, well, we've committed to this publicly, so we have to deliver to it now.
So we've seen a lot of ground up companies start, like I want to start a new neobank, I want a new debit or credit card. But one of the interesting trends going on right now is that non-fintech companies are becoming fintech companies. Take, for example, Lyft, which launched a bunch of financial products for its drivers, and that makes a lot of sense because it's higher margin for Lyft and also provides good benefit to its users. Do you think, what do you think about that trend? How do you see that continuing?
I think it's like very similar to the Apple App Store. So initially, the first version of apps that launched on the App Store were corely about new companies that were trying to do something innovative with the operating system in itself. And then once kind of the operating system became extremely stable, then you started seeing Chase, Bank of America, Facebook, like all these people that traditionally were not like iOS apps. They had web businesses or in-person retail businesses. They started launching their own apps as well. So I think very similar things are going to happen here as well. As you start seeing the barrier to entry in building these products kind of reduce and all these just become plug-and-play Lego boxes or blocks in a way, then you're going to start seeing more and more companies that have not considered launching these products before because they're extremely difficult to build, and now the barrier to entry is going down, and they will start building these more and more. What established players that are non-fintech have going for them is that they already have distribution figured out. So what they really have to do is just get the right product that they need and then distribute it across to their existing customer base. So I think that's going to happen more and more. Lyft, Uber, they're doing it. Airbnb probably is going to do it. You're also going to have companies that have not even been internet companies starting to offer this. You'll probably even see existing banks and existing firms like Prudential and all of them starting to offer more innovative products for their customers as well. So yeah, I think that's going to happen more and more, and primarily it can only happen if the barrier to entry to build and deploy these goes down.
Well, I think what's interesting too is it opens up an entirely new potential revenue stream for platforms, which can make the user experience so much better. Like if I have a massive platform, I was either going to have to charge my consumers, or like maybe I would sell their data, sometimes covertly, which never helps, never makes people too excited. I'd have to do advertising and beg them with ads. But now, maybe I could offer them a product that they actually want that has the benefit of being a super high margin for the platform.
Exactly, and then how you said, like in case of Lyft, it makes obvious sense. Like this is just something that helps their customers extensively, so they're going to add those features in there as well, and that obviously has a good increase in revenue for them. So this is one of the most, that's why this is extremely intriguing compared to other products and services that usually affect your bottom line negatively. This is essentially in addition, because you're starting to make more revenue, but also ends up adding massive value to your customer base. So we'll probably see more of that happen.
Yeah, so every company can be a fintech company.
Exactly.
And then like back to you as a founder, now that you've been scaling Synapse for a few years, what was one of the biggest surprises of being a first-time entrepreneur?
Yeah, that's a good question. I think I would probably edit that question even more. It's like, what were the biggest surprises of a first-time technical entrepreneur? Because we anticipated a lot of our scaling challenges around tech. So none of those came to me in a highly surprising way. And we're so far been able to kind of tackle most of them. Most of my challenges have come from, okay, well, at some point, me churning out code is probably not the most productive thing I could be doing. And how do you kind of like make that switch? And in most cases, when your company is growing very quickly, that switch is a step function. It's not a gradual switch. It doesn't give you a lot of time to be like, okay, I have about 6 months before I can improve on this. You have to quickly be able to change. So to me, the biggest thing has been instead of kind of being an individual contributor, which is as like a technical co-founder, most of the work is what you're having to put in by writing code, not really by talking to people. How do you move from that mindset to suddenly most of the value that I'm adding is making sure that I'm the editor for all the teams that are working on the company's different projects and initiatives. For me, that's been kind of like the biggest learning curve. But honestly, I've enjoyed it. I've kind of like gone through it. But I think that's the piece, that plus communication. Like I think those two pieces for someone who's inherently highly functioning introvert is that how do you go from kind of being like, I don't have to communicate with a lot of people, to being like, no, you have your customers, you have your employees, you have your shareholders, and how do you kind of like communicate with all of them that no, like we're kind of making progress on all these items.
VCs, drag you onto talk shows.
I know, they drag you onto talk shows, which I really appreciate, but you have to kind of communicate with all of them. And how do you do that extremely well? I think for a technical co-founder, that's probably like one of the biggest challenges.
Fantastic. Well,
also, another thing that has kind of like initially reduced my job satisfaction when I changed my mindset, improved it, is that when a company is growing really quickly, you always feel like you're running a little behind.
I think just ending on the what could be possible if financial infrastructure was a lot easier. One of my favorite examples, there's a company that helps users on food stamps. And this is because 1 out of 7 families in the U.S. is on and off of food stamps, and you think about this is a problem that a large part of the population is very, very aware of. And now, and this entrepreneur that started this company, Propel, is very smart, and I think could have navigated a whole bunch of different partnerships. And he's launched a very clever, almost personal finance manager, which shows you the balance you have in your food stamps card, where you should go shopping, and you can imagine different things that he can do on top of that. But think of entrepreneurs from all sorts of different diverse areas that have great product ideas that we probably haven't even thought of. I expect in the future some of those will be able to come to market more easily.
Well, let's talk about some of them that are extremely interesting without even naming names. Even if you talk about someone who primarily is building a product for a lower socioeconomic status customer base, the fact that as someone swiping their card and it's a grocery store, they have $20 in their account, but they need 40 to be able to pay for their groceries. The
Yep.
fact that you can in real time make those decisions is massive. Companies that are really trying to build out a better credit card experience for young graduates that are going to have a really good disposable income,
Yep.
but don't have the credit score that they need to be able to get the Chase Sapphire card. That's a big opportunity right there. All the way to being able to do business banking extremely well, like Mercury being one of the customers that we've been extremely excited about. From startups all the way to small businesses, cash flow management, all the way to accounting integrations, and how can you make all that process extremely seamless while giving them the underlying structure you need for banking. And now you have access and visibility to their burn, their P&L, and how can you build out some of the better underwriting products on top of that to be able to give out in case of startups, debt and credit. In case of small businesses, SME loans. Like those pieces are extremely exciting, all the way to high net worth individuals, and how can you build out better portfolio management for them that doesn't just only account for public stocks that they have to buy, but goes across board from checking all the way to portfolio management. That last one we haven't really seen happen yet, but we will probably in a year or something.
Yeah, so I think the good sort of takeaway for our watchers is an insight into the complexity of the existing banking infrastructure, but hopefully beyond this, won't need to think about infrastructure anymore. We'll just get to benefit from a lot of the new companies that'll be able to come to market a lot faster and serve consumers that aren't served yet, or even consumers who are served, but in better ways.
Totally. Like once you don't have to build the internet protocol, once you don't have to build the servers, once you don't have to build the operating system, guess what else can you build on top of that? And that's what we're talking about.
Awesome. Thank you. Well, thank you for joining us.
Well, thanks for having me.